In this video, we'll explore about the introduction to financial statements. In India, for any company listed on the stock exchange, the rules for financial reporting are very strict. These are governed by two main pillars. First is Schedule 3 of the Companies Act 2013 and second is IndAS 1. Together, these frameworks mandate that every listed company must maintain and publish a complete set of financial statements to keep investors informed. The first major document is the Statement of Financial Position, which we commonly call the balance sheet. Think of this as a snapshot of the company at a specific point in time. It shows you the financial position at the very end of the reporting period. On one side, you have assets, which is what the company owns. On the other side, you have equity and liabilities, which represent what the company owes to shareholders and outsiders. Next, we have the statement of profit and loss account. While the balance sheet is a snapshot, this statement is like a video recording of the financial performance over a given period. It lists out three things: income, expense, and profits. IndAS 1 also requires companies to report something called Other Comprehensive Income or OCI. These are specific gains or losses, like changes in the value of assets that are not recognized as standard income or expense. Then comes the statement of changes in shareholders' equity. This statement tracks the funds that belong to the owners. Imagine a bucket representing opening equity. When the company makes profits or issues new shares, money flows into the bucket, increasing equity. Conversely, when the company pays dividends or does buybacks, money flows out, decreasing equity. IndAS 1 actually recognizes this statement as a part of the balance sheet itself. We also have the cash flow statement and detailed notes. The cash flow statement is crucial because profit is not the same as cash. This document provides a summary of the various sources where cash came from and the uses where cash went. Alongside these numbers, you will find detailed notes. These are the fine print that explain the accounting policy and provide a breakdown of the information presented in the main statements. A single number on its own does not tell us much. That is why we have the concept of mandatory comparability. Every financial statement must contain data for the current period and the prior period side by side. The objective is to provide comparable information so you can see if the company is doing better or worse than before. While companies must show at least one prior period, they can disclose financials for a longer period if they prefer. Now, let us move to a slightly more complex topic, which is the difference between standalone financial statements and consolidated financial statements. Here, we have a conflict between legal reality and economic reality. Legally, every company is a separate registered entity. However, the economic reality is that companies are often owned and controlled by other companies, forming a large group. Let us look at some examples to understand this. Reliance Industries Limited is a parent company. It has a subsidiary called Geo Platforms, which is majority owned by Reliance. Similarly, Toyota Motor Corporation in Japan is a parent company. It has a subsidiary in India called Toyota Kirloskar Motor Limited. In both cases, the parent controls the subsidiary. If you only look at the standalone statement of the parent, you might get a misleading picture. For instance, the Toyota standalone statement only shows sales in Japan. It completely misses the performance of its global subsidiaries. This is a major limitation because for large groups, a huge chunk of value comes from these subsidiaries and standalone statements fail to capture that global reality. This is where the consolidated financial statement comes in. In this statement, we add everything up. We take the parent company plus subsidiary A plus subsidiary B and treat them all as a single consolidated group. It combines the financial performance of all the group companies together into a single statement, giving you the true picture of the total business. But how do we define control? When does a company become a subsidiary? There are three ways. First is voting rights, where the parent owns more than 50% of the voting rights. Second is board power, where the parent has the right to appoint the majority of the board of directors. And third is de facto control under IndAS 110. This means a company has the power to control strategy and operations, to change returns even if they own less than 50% of the shares. For an equity analyst, the consolidated statement is generally preferred. Why is that? Because it provides a holistic picture of the group performance. However, there are times when you must analyze the standalone statement. This is important when subsidiaries cannot distribute dividends to the parent due to strict capital controls or debt covenants. In such a crisis, you need to know if the parent company can fend for itself using only its own cash. Finally, let us look at the SEBI reporting regulations. For annual reports, filing consolidated statements is mandatory. However, for quarterly results, the rules are different. Filing standalone results is mandatory, but filing consolidated results is voluntary. While many top companies do it, it is not strictly required by law every quarter. This creates an analytical challenge. When groups do not publish quarterly consolidated numbers, there is a massive information gap. The time gap between two annual reports is nearly 1 year. As a result, analysts must often contend with dated information regarding the holistic health of the group until the next annual report is released.